Never trust a weekend pump. It's a popular saying in crypto, and that's because when crypto pumps over the weekend, it tends to create a CME gap, which gets filled 65 to 90% of the time, depending on your source. And this means that crypto prices are almost guaranteed to fall to fill the CME gap left from the previous week. Everyone knows this, but nobody understands why it happens or when it will stop. And that's why today we're going to tell you everything you need to know about CME gaps, including when they form, why they get filled, and how an upcoming change to the CME could eliminate these gaps for good. My name is Nick, and if you hold crypto, this is a video you can't afford to miss. First things first, nothing in this video is financial or investment advice. It's just educational content intended to inform you about CME gaps. If this is the kind of content you like, then prove it by smashing that like button. Let's start with the CME itself, the Chicago Mercantile Exchange, the largest derivatives exchange in the world. Now, for those unfamiliar, derivatives are any investment vehicles which derive their value from an underlying asset. Take futures, for example. When you trade futures, you're literally betting on whether the future price of an asset will be higher or lower. Now, as some of you will know, the derivatives market is estimated to be 4 to 5 times larger than the spot market. Now, put simply, the amount of money betting on the changes in price of assets is 4 to 5 times larger than the amount of money actually being invested into those assets. And this is very important to keep in mind because it means that derivatives markets can have a huge impact on spot markets. For instance, suppose that someone is shorting Tesla stock. In practice, this involves borrowing Tesla stock from someone else, selling that Tesla stock on the market, waiting for the price to fall, buying back the Tesla stock, returning it to the person who lent it, and keeping the difference. Logically, the practical effect of this short selling is, well, selling pressure, and when they close the short, there is buying pressure. Again, this is very important to keep in mind, and I'll repeat it again so you remember. The derivatives market is much larger than the spot market and can therefore have a huge impact on spot markets. And this dynamic is precisely why CME gaps have such a huge impact on crypto prices. It's basically trading activity on the world's largest derivatives exchange that's directly influencing spot crypto prices. Not surprisingly, this dynamic has resulted in lots of accusations that institutional investors have been manipulating spot markets using derivatives markets. What is surprising is that institutions like JP Morgan have been fined before for manipulating gold markets using futures on exchanges run by, you guessed it, the CME. And this has led to concerns that institutions could be doing the same thing in crypto. Now, for reference, the CME listed Bitcoin futures in December 2017, listed Ethereum futures in February 2021, listed Solana futures in March 2025, and listed XRP futures in May 2025. Naturally, this has led to speculation that institutions have been influencing the prices of these cryptos since their CME contracts listed. The catch is that the CME doesn't have that big of a market share of the total crypto derivatives market. Now, for context, it's estimated that crypto futures on the CME account for around 5% of overall crypto futures trading. Although the CME's market share of Bitcoin futures trading is closer to 20%, it's still not that big of a player. So, why do CME gaps have such a big impact on crypto prices despite the CME being such a small player in the overall crypto derivatives market? Before I give you the answer, you need to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposits on cashbacks of up to 75% on the best crypto exchanges around. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals won't be around forever, so take advantage of them while you still can, using the link down below or scanning this QR code. Back to the video. Now that we know what the CME is and how derivatives markets can influence spot markets, we can finally look at that gap. Now, CME gaps happen when the CME is closed and crypto prices go significantly above or below the last price the CME futures contract was trading at. While there are only CME futures contracts for Bitcoin, Ethereum, Solana, and XRP, Bitcoin leads and everything else essentially follows. So, suppose that there's a CME gap for Bitcoin at around $100,000, and Bitcoin is currently trading at $110,000. As we learned in the introduction, 65 to 90% of CME gaps get filled according to various research reports. And this means there is a high chance that Bitcoin will eventually fall to 100K. When it does, it will take the rest of the market down with it, because Bitcoin leads and everything else follows, as you will no doubt know. But let's back up a bit. In case you missed it, CME gaps happen when the CME is closed. Obviously, the CME is closed on weekends because it's a TradFi institution and TradFi markets only trade Monday to Friday. Specifically, the CME closes at 5 p.m. Eastern Time on Fridays and reopens at 6 p.m. Eastern Time on Sundays. If crypto prices are above or below Friday's CME close, it creates a gap. And this gap is easy to see if you look at the CME Bitcoin futures or other crypto futures on the CME on shorter term timeframes like the 4-hour chart and look at time periods over the weekends. As a fun fact, you can actually also find CME gaps between 5 and 6 p.m. Eastern Time from Monday to Thursday because the CME is closed at that time for maintenance, though these gaps don't tend to be significant since they're very short. On that note, there are two extremely important things to keep in mind regarding these CME gaps. The first is that CME gaps don't necessarily need to be filled right away. It can take days, weeks, months, sometimes years for the CME gaps to get filled, though in crypto's case, these fills happen quickly. Statistically speaking, Bitcoin CME gaps usually get filled within 2 weeks, and 80% are filled within 30 days. The second extremely important thing to keep in mind is that the CME gap is only considered filled when the CME futures price falls to the lower range of the gap, not the spot price. So if Bitcoin has a CME gap between 110.9K and 113.5K like it did recently, then the CME futures price for Bitcoin needs to fall to 110.9K for the gap to be fully filled. Anything less is a partial fill and risks prices revisiting those levels later on. Speaking of which, it goes without saying that CME gaps go both ways, not just down. If the CME futures price for Bitcoin is 120K when the CME closes on Friday at 5 p.m. Eastern Time, and then Bitcoin falls to 100K over the weekend, there's a 65 to 90% chance that Bitcoin will rally back up to 120K in the coming days or weeks. And this is why you shouldn't trust weekend dumps any more than you trust weekend pumps. But that brings us back to the question, why do these CME gaps get filled, especially since the CME is such a small slice of the crypto derivatives market? And the short answer is because of institutional investors. And this requires a bit of explaining, so bear with me. In TradFi investing, there's a popular trade called the basis trade, wherein institutions will hold an asset and then short the same amount of that asset. When it comes to crypto, a popular basis trade among institutional investors is to buy Bitcoin using the spot Bitcoin ETFs and to short an equivalent amount of Bitcoin on the CME. If Bitcoin's price goes down, the value of their spot Bitcoin ETF holdings also goes down, but the value of the Bitcoin short on the CME goes up, and vice versa. If Bitcoin's price goes up, the value of the spot Bitcoin ETF goes up, but the Bitcoin short goes down. And this method makes it possible for institutional investors to make money from fees and price discrepancies between the spot price of Bitcoin and the futures price of Bitcoin on the CME, without the risk of losing money when Bitcoin's price pumps or dumps. The caveat, though, is that sometimes the price of Bitcoin on the CME will deviate significantly from the spot price, like when the CME is closed. The outcome is that institutional investors, including hedge funds, arbitrage traders, commodity trading advisors, and others, will buy and sell Bitcoin on the spot market and the futures market to, close the gap between the spot price and the futures price for their basis trade to work. There's also the self-fulfilling prophecy aspect, where investors will just buy or sell Bitcoin anticipating the CME gap will fill. In other words, the reason why CME gaps get filled so often is because of institutional trading strategies that require those investors to buy or sell Bitcoin on the spot market to bring its spot price back in line with its previous futures price. Of course, it's a bit more complicated than that, but that's the basic explanation. It's not so much institutional manipulation as it is institutional reallocation and adjustment. It also underscores what I mentioned earlier about how derivatives markets can have a huge impact on spot markets. The CME is a small player in crypto futures, but the specific factor that causes CME gaps to move crypto prices isn't technically related to futures trading. It's related to spot trading, wherein institutions are buying or selling Bitcoin to bring its price back in line with past CME futures prices. And this is fascinating because it effectively implies that crypto spot markets aren't nearly as liquid as advertised. And FYI, many people in crypto claim that Bitcoin is the most liquid asset in the world, presumably because it trades a lot and trades against many different currencies. The thing is that lots of trading volume doesn't always equal lots of liquidity. Market depth matters a lot too. In plain English, an asset is liquid when investors can buy and sell large amounts of it without moving the price. As we've seen with Bitcoin and other cryptos, all it takes is a few $100 million of long liquidations or short squeezes to push prices up or down by 5% or more. Not only that, but as more and more Bitcoin is bought and held by treasury companies and whales, the less liquid it becomes. Come to think of it, this could be exactly why CME gaps have been such a big deal for crypto in recent months. As Bitcoin becomes less liquid, it becomes more volatile. And that means greater price swings over the weekend, which means more CME gaps, which are easier for institutions to fill because the market is less liquid. And if this is the case, then CME gaps may create more volatility for crypto in the coming months. And this brings me to the intriguing announcement from the CME in October 2025 about how they're going to start offering 24/7 futures trading sometime in early 2026, pending regulatory approval. It's practically guaranteed that they will be given approval since both the SEC and CFTC have turned pro-crypto. And what makes the announcement fascinating is the reason given by the CME's head of global equities. Quote, while not all markets lend themselves to operating 24/7, client demand for around-the-clock cryptocurrency trading has grown as market participants need to manage their risk every day of the week. Translation? Institutional investors aren't happy about the CME gaps either, as they probably force them to spend extra money to bring Bitcoin's spot price back in line with CME prices from the past. As we've learned, the primary side effect of CME gaps is that they fundamentally increase volatility in the crypto market, and it looks like this isn't ideal for anyone. It's not ideal for crypto traders and investors because they end up feeling anxious about CME gaps being filled, and it's not ideal for institutions causing these CME gaps because they end up having to spend extra money to fix their basis trades. So, when the CME introduces 24/7 futures for crypto, it will ultimately reduce this unwanted volatility, and this will make crypto more attractive as an asset class to every investor, retail who are buying and selling or holding, and institutions who are doing exotic trades. In turn, this will result in more capital going into crypto, which will support the market, particularly the cryptos listed on the CME. Until this happens, though, crypto's volatility could continue increasing because of these CME gaps, and the more cryptos that the CME lists futures for, the more CME gaps we're going to get. But again, it's important to remember that Bitcoin's CME gap matters the most here. Again, that's because Bitcoin leads and everything else follows, so don't worry too much about CME gaps for other cryptos. But remember the silver lining here. 65 to 90% of CME gaps eventually get filled. And this means that CME gaps present amazing opportunities for traders who know how to size their positions accordingly. It's safe to say that if you try to trade a CME gap with a 10x leverage thinking that it's going to be filled instantly, you have a high risk of getting wrecked. And that's because CME gaps don't always get filled right away. And that reminds me, you may have seen a few posts going around about how there are unfilled CME gaps for Bitcoin at incredibly low prices like $9,000. Well, we looked into this and found no evidence that these gaps exist. It looks like they've all been filled. And this makes sense when you recall that, statistically speaking, Bitcoin CME gaps get filled within 14 days on average, and 80% get filled after 30 days. It also makes sense when you recall that the phenomenon of CME gaps seems to have become more extreme in recent months, potentially because of increased volatility related to shrinking supply of tradable Bitcoin on the open market. And evidence for this can be seen in the fact that Google searches for CME gaps have increased significantly over the last year, despite them being around since back in 2017. Now, to wrap things up, I want to give you a bit of a tutorial on how to trade CME gaps, because this is something that I do personally from time to time. If you follow me on X, you'll know I'm always posting about CME gaps over there, so it's nice to finally talk about them right over here. The process is super straightforward. Every Monday morning, I check and see if there's a CME gap for Bitcoin futures using TradingView. Pro tip, the ticker for Bitcoin CME futures is BTC, the number 1, and an exclamation point. And as we learned earlier, CME gaps are easy to spot when you drill down into shorter time frames like the 4-hour chart. If I see that there's a gap between, say, 110.9K and 113.5K, and I can see that Bitcoin is trading above this price, then I put on a small short position and wait for Bitcoin to fall to 110.9K. And remember, you can find links to our deals page down in the description. Now, conversely, if I can see that there's a gap between, say, 110.9K and 113.5K, and I can see that Bitcoin is trading below this price, then I put on a small long position and wait for Bitcoin to rise to 113.5K. In both cases, though, I'm mindful of the fact that Bitcoin could be extremely volatile before the CME gap is eventually filled. For example, Bitcoin could fall more before it rallies back up to 113.5K. Alternatively, Bitcoin could rally more before it falls to the 110.9 CME gap in the previous example. Another thing I'm mindful of is the fact that the position could be open for many days, possibly weeks, while I wait for the CME gap to eventually fill. Besides the volatility that Bitcoin could experience during this time, I'm also mindful of the fees I could incur for keeping that position open while I wait, which many do forget. For what it's worth, trading CME gaps is exponentially easier than trading other patterns in crypto, just because you know exactly what target you're watching and you know there's a very high chance that it will be hit. It's just the pathway that's uncertain. If you size your position appropriately, use low leverage, and stay patient, trading CME gaps can be a very profitable strategy. I reckon I speak for all of us when I say that I'll be glad when this crypto market quirk is finally hammered out. But what do you think? Are CME gaps a blessing or a curse? Will you be happy to see them go, or do you want those easy trades to continue? Let us know in the comments. And if you want to learn more about how to trade crypto, then be sure to check out our Crypto Trading for Beginners guide right over here in this video. And if you made it this far and enjoyed the video, then smash that like button, and I'll see you the next time. This is Nick, signing off.